Welcome to our channel. Are you ready to uncover the truth behind one of the most devastating financial crises in recent history? The financial crisis of 2008, caused by the stock market crash, shook the global economy and affected millions of people. Today, we'll take a closer look at the events that led to the crash, the causes and consequences of the crisis, and the impact it had on the world. This is a must-watch video for anyone interested in understanding the complex web of events that led to the financial crisis of 2008. So, sit back, relax, and get ready for an informative and thought-provoking journey through one of the most significant financial crises in recent history. Don't forget to hit the subscribe button and turn on the notification bell to never miss an update from our channel. The collapse of Lehman Brothers refers to the bankruptcy of the Lehman Brothers Holdings Incorporated, an American multinational investment bank and financial services company, on September 15, 2008. It was one of the largest and most complex bankruptcy cases in U.S. history, and it had a significant impact on the global economy. Lehman Brothers had invested heavily in subprime mortgages and other risky assets, just like many other financial institutions. As the housing market collapsed, many homeowners defaulted on their loans, and Lehman Brothers found itself in financial trouble. The bank tried to raise capital to stay afloat, but was ultimately unable to do so, and it filed for Chapter 11 bankruptcy protection on September 15, 2008. The collapse of Lehman Brothers was a key event in the 2008 stock market crash and the financial crisis that followed. It was the largest bankruptcy in U.S. history, and it led to a domino effect, causing many other banks and financial institutions to fail or require government bailouts. The bankruptcy also led to a severe credit crunch and a liquidity crisis, which in turn led to a global recession. The collapse of Lehman Brothers was a significant event that highlighted the interconnectedness of the global financial system and the risks inherent in the complex financial instruments and practices that had become prevalent in the years leading up to the crisis. The Troubled Asset Relief Program, TARP, was a program created by the United States government to address the financial crisis of 2008. This crisis was caused by the collapse of the housing market, subprime mortgages, and the failure of many banks and financial institutions. TARP was designed to stabilize the financial system and protect the economy from a collapse. Under TARP, the government purchased assets and equity from financial institutions to provide them with capital and stabilize them. The government also provided guarantees to the banks and other institutions to encourage them to lend money to each other and to consumers. The goal of TARP was to restore the flow of credit in the economy and stabilize the financial system. It was also intended to prevent the failure of additional banks and other financial institutions. TARP was a controversial program, but it was considered by many experts to be necessary to prevent a complete collapse of the economy. The Federal Reserve, also known as the Fed, is the central bank of the United States. When the financial crisis of 2008 happened, the Fed took several actions to try and stabilize the economy and prevent a complete collapse. One of the things the Fed did was to lower the interest rates, which makes it cheaper for individuals and businesses to borrow money. This was done to encourage people to spend money and keep the economy moving. The Fed also provided loans to banks and other financial institutions to help them stay afloat and avoid failure. In addition to these actions, the Fed also worked with other government agencies and international organizations to coordinate efforts to stabilize the financial system and prevent a global economic depression. Overall, the Federal Reserve's response to the financial crisis of 2008 was to take a series of actions to stabilize the economy and the financial system and prevent a complete collapse. The financial crisis of 2008 had a significant impact on the global economy. When the crisis happened, many banks and financial institutions failed, and the stock market dropped sharply. This caused a loss of confidence in the economy, and many people and businesses stopped spending money. This decrease in spending led to a decrease in economic activity, which caused many businesses to go bankrupt, and many people to lose their jobs. This in turn led to a decrease in income and an increase in poverty. The crisis also led to a decrease in the value of assets, such as homes and stocks, which caused a decrease in wealth for many people. This further decreased spending and economic activity. The financial crisis of 2008 had a ripple effect on the global economy, and it took several years for the economy to recover. It had a significant impact on the lives of millions of people around the world, and the effects are still being felt today. As we come to the end of this video, it's important to remember that the financial crisis of 2008 affected not only the economy but also the lives of millions of people around the world. The lessons learned from this crisis should be remembered and implemented in order to prevent another financial crisis from happening again. And this was all about the financial crisis caused because of this crash. In the next part, we'll see the effects of the crash. So make sure to subscribe our channel and smack the bell button to get the notification for the